On January 27, 2025, NVIDIA lost $589 billion in a single trading session. Not over a quarter, not over a year, in one day. That number is larger than the combined market cap of Oracle, Intel, and AMD. It vanished because a Chinese startup published a cheaper AI model. A company worth $3 trillion moved 17% on a software announcement. That is not normal volatility. That is a market telling you something about the foundation underneath. On screen, $589 billion, one trading day, January the 27th, 2025. The foundation is this. NVIDIA's entire business now rests on one segment, data center. That segment represents 92% of total company revenue, up from roughly 60% 2 fiscal years ago. And inside that segment, 4 customers account for 54% of all receipts. Individual shares ranging from 11 to 16% each. 4 companies, more than half the revenue. That is not diversified growth. That is concentration dressed as dominance. Those 4 companies are Microsoft, Google, Amazon, and Meta. They are the largest technology businesses on Earth. They are spending at a scale that looks like permanent demand. Hyperscaler capital expenditure hit $138 billion across those names, plus Oracle in a single quarter, Q4 2025 alone, up 66% year over year. Goldman Sachs projected the group would spend over $380 billion in 2025, with more than $500 billion projected for 2026. The numbers are staggering. The market treated them as proof. What the market did not price was what those 4 companies were building while they wrote the checks. If you are not already subscribed, this channel covers the financial machinery underneath the AI headlines, the part most people miss. Subscribe before the next one drops. Google has deployed its 7th generation custom chip, TPU v7, called Ironwood, which analysts describe as arguably on par with NVIDIA's Blackwell architecture. Amazon has put more than 500,000 Trainium 2 chips into production for Anthropic's model training. That is the largest non-NVIDIA AI compute cluster ever built. Microsoft has its Maya line. Meta has its own inference accelerator. Every one of NVIDIA's 4 largest customers has a funded, staffed, and shipping program to replace NVIDIA silicon for internal workloads. Analysts estimate custom silicon now offers a 40 to 65% total cost of ownership advantage over NVIDIA GPUs for the workloads it handles. On screen, 4 customers, 54% of revenue. NVIDIA's 4 biggest customers are building the exit while paying the rent. The exit takes time. Custom silicon does not replace NVIDIA overnight. CUDA's software ecosystem represents years of switching cost. But the investment is not experimental. It is structural. The commitment is made. The roadmaps are public. And the economics are clear enough that none of the 4 will stop. What keeps the spending at these levels is a loop that has no external floor. Hyperscalers fund AI startups. Those startups use the capital to rent cloud compute. The cloud compute runs on NVIDIA chips. NVIDIA's revenue validates the hyperscaler's own CapEx narrative. The CapEx narrative supports the hyperscalers' market caps. The market caps support their ability to raise capital and fund more AI startups. Around it goes, NVIDIA's revenue is estimated to represent roughly 45% of total hyperscaler capital expenditure. The supplier's income is derived almost entirely from the customer's spending, and the customer's spending is justified partly by the market's belief that the supplier's demand is real. The market is counting the same dollar more than once and treating each count as independent growth. On screen, $138 billion, hyperscaler capex, 1 quarter, Q4 2025. Underneath the money loop, there is a physical layer. Every advanced NVIDIA GPU is manufactured at TSMC in Taiwan. That one foundry produces approximately 92% of the world's advanced AI chips. Everything at 7 nanometers and below. The high bandwidth memory stacked into those chips comes from 2 Korean companies, SK Hynix and Samsung. Together they control roughly 88% of global HBM production. SK Hynix alone controls between 35 and 64% depending on the measurement period, and was reported as sold out through 2027. TSMC's Arizona facilities will not operate at frontier node scale until 2028 to 2030 at the earliest. In April 2024, a magnitude 7.4 earthquake struck Taiwan, the largest in 25 years. TSMC evacuated its fabs. Within 10 hours, they had 70% of equipment back online. The system held. This time. On screen, 92% of advanced AI chips, one island, one foundry. The world's most valuable AI company runs its entire hardware supply through a single geographic choke point in a geopolitically contested strait, fed by two Korean conglomerates with no near-term alternatives at scale. While regulators in Washington have focused on the geopolitical dimension, the DOJ Antitrust Division was reportedly building a separate inquiry. According to Bloomberg, the San Francisco office was examining NVIDIA's conduct in data center pricing. NVIDIA publicly stated it had not received a subpoena, a denial that itself created market confusion. The software layer compounds the question. CUDA, NVIDIA's proprietary compute platform, is the reason switching costs are measured in years rather than quarters. The hardware dominance and the software lock are a combined structure. John Petty Research reported NVIDIA shipped 92% of add-in board units in Q1 2025. A company simultaneously called a national security asset and quietly examined by antitrust investigators is a company the government has not finished deciding what to do with. On screen, 92% NVIDIA's revenue from a single segment, data center. The market already gave one answer on January 27th, $589 billion gone. The largest single-day market cap loss in U.S. stock market history, more than the full combined value of Oracle, Intel, and AMD, triggered by a cheaper AI model from a foreign startup. Not a fraud, not a product failure, a cheaper model. Analysts at Cantor wrote that the event had caused great angst as to the impact for compute demand. The stock bounced the next day. Within weeks, the narrative had recovered. The number had not. If efficiency gains reduce the GPU hours required per AI task by 30 to 50%, NVIDIA's demand curve redraws. The market chose to treat DeepSeek as a one-day event. The math does not expire. That forgetting has been distributed into every index fund in America. If you have found any of this useful, subscribing takes 2 seconds and keeps this kind of research coming. NVIDIA now represents approximately 8% of the S&P 500 by market cap, the highest single stock concentration in more than 50 years, surpassing the multi-year dominance of Apple. In 2024, one company produced 22.4% of the entire index's total return. In the NASDAQ 100, the 5 largest names, NVIDIA, Microsoft, Apple, Amazon, Alphabet, account for 55.4% of the index. RBC Wealth Management published an analysis in January 2026, calling this the Great Narrowing, and noting that more than $40 of every 100 invested in the S&P 500 flows automatically into just 10 companies. On screen, 8% of the S&P 500. One company. A passive investor who believes they hold 500 companies holds a leveraged bet on a hyperscaler capex cycle they cannot examine, cannot time, and cannot easily exit. The equal weight S&P 500 fell only 2.9% during a brief tech sell-off in February 2025. The cap-weighted version, the one in most 401ks, fell nearly 5%. The difference is concentration. The ordinary investor carries that difference without choosing it. It accumulated through market cap weighting. It accumulated automatically. Workers at Supermicro, Dell, and Oracle, companies that supply the server infrastructure running on NVIDIA chips, fell between 8 and 17% on DeepSeek Day, alongside the chipmaker itself. Those workers did not build the concentration. They did not approve the CapEx commitments. They carry the downstream exposure because their employers' business models depend on the same assumption, that AI hardware demand at current scale is permanent. On screen, 22.4%, share of the S&P 500's 2024 total return, one stock. There is a company that went through this before. In the late 1990s, Cisco Systems was the dominant infrastructure supplier of the internet build-out, the picks and shovels company. The one you wanted to own because no matter who built the internet, they would need Cisco equipment. The thesis was correct. Cisco's revenues grew from roughly $19 billion in fiscal 2000 to more than $52 billion 2 decades later. The company won. In March 2000, Cisco was the most valuable company in the S&P 500. Its price-to-earnings ratio stood at 201 times. Over the next 2 years, its stock collapsed 88%, from $79 to $9.50. On a total return basis, it took 20 years to recover. The business kept growing. The shareholders waited. Cisco's collapse was partly structural. Its boom had been underpinned by vendor financing. Cisco lent money to telecom customers to buy its own equipment. When WorldCom collapsed in accounting fraud and Global Crossing went bankrupt after laying undersea cables that found no customers, Cisco wrote off nearly $900 million in bad loans. The equipment manufacturer had counted demand from entities funded by capital markets, not organic revenue. More than 20 major telecom companies failed. The sector carried over $1 trillion in unrecoverable debt. On screen, Cisco, peak 2000, down 88%. Recovered 25 years. In February 2026, Michael Burry, the investor who bet against the subprime mortgage market before 2008, issued a warning about NVIDIA. He called NVIDIA's aggressive supply chain commitments a structural parallel to Cisco's posture before the crash. "This is not business as usual," Burry said. "This is risk." On screen, "This is not business as usual. This is risk." Michael Burry, February 2026. NVIDIA has real earnings, real margins, 71% gross margins in fiscal year 2026, real products shipping at scale. Its trailing price-to-earnings ratio as of late 2025 stood at approximately 56.5 times, elevated but not the 201 times of Cisco at the peak. The fundamentals are stronger. The structural position is identical. Dominant infrastructure supplier, dependent on a build-out. Exposed to the moment the build-out normalizes. Sitting at a valuation premium that assumes the build-out never does. Cisco was right about the internet. The internet did transform everything. Cisco's revenues more than doubled over the following 2 decades. None of that mattered to the shareholders who bought in at the peak. They waited 25 years. The premium they paid assumed permanent expansion. The expansion normalized. The premium collapsed. The business continued. NVIDIA may be right about AI. The GPUs will keep running. CUDA will remain the dominant software layer for years. The real productivity gains from AI inference and training will persist after any financial correction. The data centers will still be in the ground the same way the fiber cables stayed in the ground after WorldCom. On screen, the technology doesn't have to be fake for the trade to be wrong. What will not survive the normalization, if it comes, is the assumption that every dollar of hyperscaler AI capex represents proven, durable, external demand. That assumption is the connective tissue between NVIDIA's market cap, the S&P 500's concentration, the retirement accounts, and the workers downstream. It is the assumption the DeepSeek event briefly exposed, and the market chose to rebury. The bubble does not have to kill the technology to do the damage. It only has to kill the story people told about the technology. Cisco survived. The fiber survived. The internet survived. The shareholders who bought the infrastructure winner at the peak of the build-out, they did not. The technology doesn't have to be fake for the trade to be wrong. If this gave you a clearer picture of what's actually underneath the AI boom, subscribe. Most people watching the headlines are missing the structure. That's what this channel is for.